If you own a rental property and you're not doing this, you're probably overpaying your mortgage by hundreds of thousands of dollars. But what if I told you you can save hundreds of thousands in mortgage interest, decrease the amount of income tax you pay, and shave years off your mortgage by using a CRA approved tax strategy that requires no increase to your monthly budget? Well, that, my friend, is called rental cash jamming. And in this episode, I'm going to be running through exactly how it works, the pros, the cons, who it's good for, and all of that good stuff. And if you haven't heard of this podcast or show or YouTube channel, hit that subscribe button because I will be chatting about more strategies like this and showing you how to increase your net worth. So, as a reminder for those of you listening, or if this is your first time listening, this is unscripted, unpolished. I'm not even editing any of this stuff. I will be screwing up. So bear with me, but the information in this episode is going to be really, really good stuff. I'm going deeper on a lot of the topics and subjects I talk about on my social media. And this is going to be one of those episodes. So with rental cash jamming, what I'll do is I'll go through a high level overview of how it works. So if you have a rental property, you own at least one rental property in your personal name, you have a primary residence with a mortgage, then essentially all you're doing is what you're doing right now, you're likely doing is you're taking your rental income from your tenant and you're paying your expenses directly from that rental income. There's nothing wrong with doing that, but you're really just missing out on some additional tax deductibility. And what I mean by that is making your primary mortgage tax deductible. So in Canada, the standard, the default is mortgages, the interest on your mortgage, on your primary, is not tax deductible. On your rental property, it is. So with rental cash jamming, it's an advanced strategy to allow your primary home mortgage interest to be tax deductible as well. And how we're doing that is by doing two extra steps when you get your rental income. So imagine you get your pay, say it's $2,000 from your tenant in the form of rental income. You're going to take that and you're going to make an additional payment on your primary home mortgage right away. So you're going to be doing that through your prepayment privileges that your mortgage has within that your mortgage has in terms of features. So every lender has different prepayment privilege features. You can either have 10%, 15%, or 20%. The standard is around 15 to 20%. Some lenders have 10%. So I'm going to just keep that in mind. I'm going to circle back on that. But when you make that additional payment, you want to make sure your mortgage is set up properly through a readvancing home equity line of credit. So as you pay down your mortgage, let's say it's at $2,000 in rent, it's going to free up $2,000 in limit on your home equity line of credit. Now that that happens, you're able to now pull from your line of credit and pay for your rental property expenses. So as you can imagine, it's just one loop and you're doing two extra steps before paying for your rental property expenses. The expenses are still getting paid. You're still getting the same rental income, but now we're able to claim the interest on your home equity line of credit, whatever that balance is. So as you do this monthly, yearly, the balance on your line of credit is going to increase, which is a good thing because it's going to be tax deductible at this point, and your mortgage is going to decrease because you're paying that extra payment every single year. So the payment on the balance on the mortgage is decreasing aggressively. So when it comes to cash jamming, you have three main phases. I like to break it up in three phases. The first phase is you want to convert that debt as fast as possible. So if you have a $500K mortgage, you want to get rid of that as fast as possible and have the remaining on the line of credit. So that's our first focus. The first phase is to convert the debt. Once that happens, then we're going to focus on paying down that line of credit. So at this point, this is the really cool part and what a lot of people miss or don't comprehend, and it's not their fault, but what really drives me nuts is when you see other people on social media bashing rental cash jamming because they don't understand this part here. So when you convert your mortgage to your line of credit, you can then convert that line of credit back to a mortgage component and it still remains tax deductible. That's the really cool part. So you're not having the balance sit on a line of credit forever because the argument is, hey, the line of credit interest is going to be higher than your mortgage interest. That is true, but we can convert it to a mortgage component. And for some people, if you have 2, 3, 4 plus rentals, that debt conversion period becomes shorter and shorter. The more rental income you have coming in, the shorter amount of time it takes to convert that debt, which is a good thing. For some people, like we just built out a budget for a client the other day. She has 4 rentals. We're converting her debt in 3 years. 3 years. That is super, super fast. So her debt is only going to be sitting on the line of credit for 3 years. But for most of you, you probably only have one rental, but that's okay. This still works with one rental property, because even if your debt conversion takes 10 years, you can convert that line of credit balance into multiple mortgage components along the way. So that sounds confusing, but let's just imagine you start the rental cash jamming, you pay down 100K on your mortgage balance, and you have 100K on your line of credit. It's never a dollar for dollar like that. It's actually going to be less on your line of credit, but let's just stick there as an example. So that 100K on the line of credit, depending on the lender you're with, you can convert that to a mortgage component, and you can keep doing this along the way and have multiple mortgage components. The benefit of this is that once you convert that line of credit to a mortgage component, the interest rate drops. So that's a cool part about that. I got some notes here. Let's dive through some common questions I usually get. Okay, well, that was first two phases. The third phase is investing the future payment savings. So as you can imagine, you're going to be paying down your mortgage much more aggressively. So you're shaving years off the amortization, meaning you're going to be mortgage free years sooner. So on average with our clients, we're seeing between 5 to 15 years shaved off their mortgage. So let's just say you're shaving 5 years off your mortgage. At that point, you're going to be mortgage free 5 years sooner, but you would have otherwise just been making those same mortgage payments for those 5 years. So let's just say you're on pace for 25 years to pay off your mortgage, but we paid off in 20 years. Those 5 years of payments that you would have been paying, let's invest that. And that's what we show in our calculators too. Instead of just pocketing the money and doing whatever, you can absolutely do that. But if you want to grow your wealth further, you can invest those payment savings in, say, the S&P, get a 9% return, and grow your money even further. So that's a third phase. It's an optional phase, but some people love opting in for that because, again, it's growing your wealth even further. But the main two phases are the most important, in my opinion. I mean, the first phase out of anything is convert the debt as fast as possible, because we even have some clients that decide, you know what, I just want to convert my debt to make it tax deductible. I'm just going to let it sit there. I'm going to pay the interest only payments. I'm not even going to convert it to a mortgage because I don't want to pay it down. I just want the tax deductibility component to it, which is completely cool. That's if you're, wanting to allocate your money towards more investments. Absolutely. It's a strategy you can do. Some people are like, hey, you know what? I don't like the tax refunds I get from the tax deductibility. I just want to invest those tax refunds and not contribute it to the mortgage. Because one layer of cash jamming is, because you're converting that line of credit to tax deductible interest, at the end of the year, you get tax refunds if you're salaried. So if you're a salaried, employed individual, you'll get those tax refunds. And what we assume is that you're going to take those tax refunds and apply it to the mortgage again. So you're paying it down even further and further. So that's like the main strategy, but some people opt into taking the tax refunds and investing it in the S&P, which can actually yield you a far greater result over time. But it really just comes down to preference. Some people like the peace of mind of just being mortgage free, which is absolutely cool. And if you're self-employed, you wouldn't be receiving tax refunds. It would be you're reducing your tax liability. So if you're self-employed, you're likely paying taxes. So at that point, you're just paying less tax, which is awesome. Or if you're incorporated, you're taking less money out of your corporation. So those are the two distinguished differences there between employed and self-employed. Now, some of the questions I get are HELOC interest. Like, what happens with the home equity line of credit interest? When you run rental cash jamming, you can service the line of credit interest with the line of credit itself. So when our team sets people up with the implementation, we have our clients open up a clearing account, which is just a fancy way of saying we're going to open up a checking account. The checking account is designated for the rental property expenses. So what we do every single month is, as the line of credit interest builds up, the balance, then we're going to keep pulling from that to pay for the rental property expenses, but you can't do it directly from the line of credit. We want to keep it clean. So we're going to transfer it over to a checking account, which is the rental property clearing account. And all we're doing is we're just paying the expenses from that account. And every single month, you're just pulling enough interest to pay for that line of credit into that clearing account, and then you're transferring it back to the line of credit. Now, this all sounds very complicated, probably just hearing it through a podcast, but I promise you it's simple once it's set up. And you just want to make sure you're not commingling any debt. So you don't want to have your personal debt commingled with your business debt, which leads me to my next point. The reason why we're able to do this is because it falls under the CRA's rules, under the, you're going to want to write this down, the Income Tax Folio S3 F6 C1 Act. So, what that is basically saying is as long as we are using the line of credit to service the rental property with the expectation to generate income, we are able to write off the interest. So, yes, it flies. It is 100% legal. It's compliant with the CRA. The main thing we want to do here is we want to make sure we are not commingling debt. We don't want to have you use a line of credit for, say, you bought a Sea-Doo next month. I don't know why I said Sea-Doo, but whatever. We're going with it. You don't want to mix that with your rental property expenses. So that's a no-no. If you do that, there's ways to back it out, but you don't want to go that route, because if you get audited by the CRA and you've got personal expenses on there, you are in trouble. It's probably going to ruin the whole cash damage strategy for you. So when we set clients up, we make sure we give them the rental property expense tracker. So it's a spreadsheet where we track the expenses every single month, no commingling, and we make sure we have that clearing account set up. Those are the main three things we want to have. All right. So what else do we have? Higher rate. We talked about that. Okay. So that's cash damming in a nutshell. Now, if you have any further questions, please just send me an email or comment on this podcast. If you're on YouTube, comment on the video. And yeah, we're going to talk more about cash damming, the pros, the cons, the common FAQs, which we touched on it a bit here. But I just wanted to start out with more of a general overview of cash damming, because these are some of the stuff that I often hear from people on social, questions, all of that good stuff. So I'll leave it at that, and we'll see you next week.